Now, implied volatility, what is it, right? A lot of people talk about it and they throw this buzzword around, but what the heck is implied volatility? We know what historical volatility is, or volatility when we read it on the charts. If we see a big bar on the chart, like on the VIX back here on December 3rd, this is a big bar. We call that a volatile bar. It means that the investors were in there, the buyers were going, the sellers were going, and all that good stuff. That's historical volatility, but implied volatility is guessing about what the volatility is going to be in the future. What is, and how do they do that? How do they determine that? They do it from options. They do it from futures. The derivatives market is a market that people use to hedge their investments. And so when they start buying derivatives, buying options as insurance, it causes the price of options to go up. And you can actually mathematically take an options price and derive out its expiration date. In other words, the effect of expiration date on its price. You can derive that out, and you can even derive out the underlying symbol price. And what's left is the buying and selling pressures on that derivative. And that's the implied volatility. In other words, if there's a lot of demand for options as insurance to underlying symbols, even like the SPX or the SPY, that means that people are worried. There's fear in the market, and that's how they determine implied volatility versus historical volatility or actual volatility we can see. And at the same time, if the price of options go down after you factor out the effect of, expiration date, and you factor out the effect of the underlying symbol price changes, and you're left with a lot of supply and not much demand, it means people are very confident, and the implied volatility goes down. So implied volatility is reverse engineering the option price.